Hi, everyone. Welcome to February 2021's edition of the Business as Usual podcast. I am delighted to be back with Mike and not having to do it all on my own. Mike, how are you feeling?
Yeah, a lot better. Thank you very much, Jack. Good to be
Good,
back.
good, good. So we've got quite a few things in this podcast we're going to do. So we didn't do an exam question last time, so we're going to do an exam question this time. And we've got quite a few news headlines that we want to go through. Mike, do you want to talk us through what we've got coming up?
Yes, so this month we've got last month's big news headlines, but you'll notice they've all been very, very recent. It's all been jam-packed towards the end of January. We also will be looking at Ansoff Matrix in 5 minutes, and as our key topic, and then we'll be looking at another key student misconception slash problem, which is why do students often underestimate the importance of profitability?
Yeah, as obviously I mentioned at the start, we'll do an exam question at the end as well. Just before we get started, remember that you can follow us on Twitter and Instagram at Business AU Pod. So just so you don't miss out on any future episodes. So with that introduction all done, let's get started. So our first news story is about Burger King, and this was something that caught my eye. I'm quite interested in branding. I'm always quite interested in how businesses sort of position themselves using their brand. And one thing that I think has been quite common over the last few years is a lot of businesses seem to have kind of simplified their branding, especially their logo. It seems like a bit of a minimalistic view is sort of more common now, and Burger King are the latest business to do this. They've kind of gone retro with their rebrand. They've actually gone back about 20 years and they've changed their logo to a variation of what it was when they first started. And we looked at this and we had to read a few articles to try and figure out why they've done it, aside from the obvious reasons why a fast food business might want to change the way they're perceived on any given day. And there was just this one quote that I thought was quite interesting from someone in charge of Burger King. They said, "Our choice to remove the color blue was somewhat symbolic of Burger King's recent removal of colors, flavors, and preservatives from artificial sources." Now, Mike, isn't that exactly what you thought when you looked at this rebrand?
Totally. That's exactly what I thought. I was like, there goes the blue. We know why
Yeah.
that's gone. An absolute joke. So Burger King is no surprise to anyone, is it? They are clear second place in the fast food American fast food market over here in the UK. Miles behind McDonald's, and they seem to think that a cheeky rebrand will solve all their problems. Do you think it worked, Jay?
I don't think it's necessarily going to move the needle, but I also don't necessarily think it's the worst idea. I think the branding's pretty nice. It's very in fitting with what's happening with a lot of businesses where they've gone to that more retro feel. They're going back to their roots a little bit. I am personally of the opinion that Burger King is superior to McDonald's in every single way. So, I mean, I've got a little bit of existing brand loyalty to Burger King. I don't think it's gonna make a huge amount of difference, but it is interesting that they're making that they're actually, trying to do something drastic. It's gonna change the decor of all of their stores. It's effectively simplified, isn't it? They've gone with very kind of, retro colors, very sort of 60s, 70s kind of colors. They've introduced their own font, but ultimately, I mean, is that gonna help them overtake McDonald's? No. Is that gonna make people think suddenly that these burgers are healthy? No.
No, I mean, I was saying this to you earlier on when we first spoke about it. I look at that Burger King logo, and it reminds me a little bit of I was saying Wimpy,
Mhm.
which
Yeah, you're right.
aren't about much anymore. But when you think Wimpy, you think old school. When you were a kid, it's
Nostalgia
very
kind of thing.
basic, exactly nostalgic.
Maybe
You're
that's
thinking
part of the
American
point.
Diner.
Mhm.
Burger King, could have gone American Diner, but I suppose you've got what's the other brand that all the kids love? Um,
Five Guys,
Five Guys, that's the
Shake
one.
Shack.
They've kind of
Yeah,
gone with that kind of theme, haven't they? So I suppose
yeah.
that market's cornered now. I honestly don't know how Burger King can ever compete with McDonald's in this country.
Scale, really, probably. I would say that isn't that the biggest benefit that McDonald's has got? The fact that they're just so much more present because they have so many more
Convenience.
stores.
Mm,
They're a bit cheaper as well, but I just thought it was interesting to think about. I always find it interesting when big businesses, like the biggest businesses that everyone's heard of, make a big change. I always find those really interesting. Let's have a look at a second news story, which is one that I think, it's not necessarily pure business studies kind of thing, but it's something that's definitely been in the news. And I just thought, we kind of figured, given how in the news it was worth talking about. So this stock market stuff. I'm not big on the stock market. I'm not an investor privately or anything like that. And so, Mike, you're probably going to be a bit more equipped to talk about this one. What's kind of happened with GameStop over the last few weeks?
Right, so GameStop, for people that won't know, is similar to Game, like we had over here, but in a much worse position than Game, if you can believe that. So GameStop sold, your PS5, if you can get one, at your your Xbox games, um, and that kind of stuff in general, PC games. But yeah, so they sold that on the high street, struggling, looking like the shares were never going to be of any value. So hedge funds in the US thought it'd be a good idea to play their game with GameStop, and they would short it. So essentially, bet against the share price, betting on it going down. And what happens is when a hedge fund puts enough of a bet against the value of a stock, then other people start getting concerned about the value of that stock. And those people that hold the stocks will then look at selling their shares. And then what happens to the share price? The share price naturally falls. Supply and demand, like even business students would have done that in year 12. So you
Yeah.
increase the supply of the shares on the market, the price plummets, then you and I, your gran who's got a share in them, starts getting worried, sells them, and there you go. And then once the price goes down enough, the hedge funds buy up the stock that they've
When
essentially
it's kind of
borrowed.
artificially low, isn't it? So yeah,
Yeah,
yeah, the concept of shorting is where they borrow these shares from shareholders, and they sell them at their market price,
yeah,
and then they're expecting the share price to drop, or the share value to drop, and so they kind of sell it at like $10, for example, and then when it drops to $5, they buy it again, and so effectively
and give
they've
it back.
sold it for 10, they've bought it for 5, so they've made a $5 profit. So yeah, and then they give the share back, but they make the money, but
The difference.
they make the difference between what they sold it for at $10 and what they bought it for at $5. And so it seems like it's something that these hedge funds do quite on a regular basis, where they
Only
almost
every day.
intentionally, yeah, without a doubt. So they kind of intentionally drive down the value of the stock so that they can make this profit on it. And I guess the difference is, this time a group of people on Reddit decided that instead of allowing the share price to drop, if they all bought shares on it, the share price would, of course, as supply and demand works, if there's a huge demand for something, the price is going to increase. So they all bought their shares, and the price of GameStop stock just soared, and it's gone kind of up and down. I think it's in a bit of a sink at the moment, but it's an interesting story, because it seems like it's a large group of individuals on Reddit, who are kind of trying to play the hedge funds at their own game. Mike, how would you describe a hedge fund for those who don't know what a hedge fund is?
So a hedge fund is an investment company, a limited investment company. Think of like a bank, like Barclays Capital, but they will invest in much more liquid stock. So they're not where you're going to put your pension money, and they're going to invest it in like 10-year bonds or in shares. At the Barclays Bank for, like, say, the next 20
Yeah,
years for when you retire. They're going to be trying to do high risk investment with your cash, with your capital, to give you a sizable return. And we're talking about the people that put their money into these hedge funds will be on the phone asking why they're not making that return on that large sum of money, and they will threaten to take that money out if they don't. So these hedge funds are under huge pressure to make really good returns. So it doesn't obviously, but it tends
yeah,
to force them to do nefarious activity, which is like shorting the stock.
yeah.
And you explained shorting the stock perfectly, but the key thing is that there is always a deadline on that short. So it could be
Right,
like a
yeah.
week.
So that's
So
what I
they
was
have
about to
to.
say. They have, if they borrow the say, for example, if I'm gonna do this and I borrow a share from you, I have to give you that share back. And what I'm hoping is, if I sell it today, and I mean, let's say we're gonna post this on Monday. So let's say that today's Monday, and I borrow the share from you on Monday and I sell it on Monday. say for example, if it's a 1 week deadline, I have to give you your share back next
Yeah,
Monday. I'm
indeed.
hoping that in that time between now and next Monday, the share price will drop and I can buy it again and make that profit I talked about earlier. The problem is at the moment, or what happened over the end of January, and why this is such a big deal is the investors buying GameStop stock caused the price to increase to something like, I think it was like $350.
Hmm.
And if that is the price the following Monday, I have to buy that stock at that price, and
Yeah,
I'm going to
it'll
make like a
automatically trigger.
$340 loss
Yeah,
for every one share. So I'm going to basically have to buy these shares so that I can give them back to you, but I'm going to have a huge loss to do this. And I think one of the big investment banks and one of the big hedge funds collapsed, didn't they? They ended up something like they lost billions and billions of dollars on this because they had to buy the shares back at such a high price that they actually didn't have the money to do it
I think, don't quote me on this, I think they were set to go
before it
bankrupt,
dropped
but
again.
what happened was is this is typical. I don't want to get too much into conspiracy, etc. But like the hedge funds have powerful people putting their money into the hedge fund. The hedge funds, therefore, by extension, is powerful. So therefore, the hedge fund lean on the places where you can buy these stocks,
Like the
like
Robinhood
Robinhood.
app, yeah,
Yeah. So Robinhood took it off, so you couldn't buy them. So then, if you can't buy them on there, you can only sell. Trading,
yeah,
is it 212 as well?
right,
They've
yeah.
taken it off. I mean, that's really popular. That's what these Redditors would have been buying on. So if you can't keep buying them, then the share price is only going to then fall.
It's gonna, yeah, no
So
doubt,
then
and
if it
that's what
falls to a
happened,
price where the
yeah.
hedge funds don't lose too much, then they've come off kind of unscathed. But this is more, I'd like to think of a symbolic kind of, you know, um,
It's a gesture, isn't it? It's a group of
yeah,
individuals saying, actually, do you know what? We can you can, make your profit in this way and you can rich become richer and stuff like that. And it's kind of just a group of people saying, actually, do you know what? No, actually we can play this game as well and we can, you know, we can hurt you in this position because there's obviously a lot of anger towards hedge funds that make what they want to happen in a market happen for the benefit of profit.
yeah, it's
But
kind of the
but
rising
yeah,
up
I
of the
think
working class kind of idea, isn't
yeah,
it?
no doubt. I think it's a really complicated thing, and I have to be honest. It's nice that you said that my explanation was good because
Mm,
about 2 weeks ago I had no idea. I didn't know anything about this. I've always stayed away from investment because it's very risky and because I didn't have the knowledge. And so I've read quite a few good articles. The one that I've put on the slide, if you're watching this on the video, you'll be able to see it's a New York Times article. That was a pretty good article. If you find that, the title's "Dumb Money is on GameStop and it's beaten Wall Street at its own game." This was kind of before the price dropped again. Read some articles on it because it's really interesting and it'll give you a really interesting insight as to into investment. And I know that a lot of students, especially in the sixth form age, get really interested in this concept of how you can invest in companies and potentially make some money on it.
and
So
I love it.
yeah, so we don't want to go any further than that because we've probably gone further than we wanted to. But
Yeah.
it's such an interesting story. I would just encourage anyone who's listening who finds that interesting to either, by all means, email us. Our email address will be at the end and ask us any questions, and we'll see what we can do
Mm.
to answer them. Maybe we can even mention it next month as well, or do a follow-up podcast if there's a lot of interest. But
And I'd
read
also
some
say,
articles
oh,
as
sorry, go on.
well. No, go ahead.
I'll say, and also, if you are interested in this, you find this interesting, then you've probably already watched like Wolf of Wall Street, but also watch a show called Billions, where it's all about a hedge fund that does all this dodgy activity, and it's really interesting.
I've heard it's good. I've never watched that, but I've heard it's really
It's
good.
amazing if you're interested in this. If you're not, then
Yeah.
you won't like it probably. But it's
Is
got
there a
amazing
film?
actors in as well.
Is there a film called The Big Short as well that talks about this
Yeah,
a
The
bit?
Big Short.
I
Most
haven't seen
most
it, but I've seen
students have
it.
seen that.
I've seen it mentioned a lot over the last week or so because it talks about this. Um, okay, let's move on to our third news story then, and let's change the pace a little bit. So we have mentioned a bunch of times about different businesses in this fashion market. We talked about so many businesses going under and being a huge risk, like high street retail. And one of those businesses was Debenhams. And we talked about this at the time. I think was it Debenhams we were talking about as a potential. No, we were talking about Topshop and
Yes.
how Boohoo were one of the potential suitors for Topshop because they could buy some of those brands, they could sell them in their Boohoo websites, which are obviously very successful.
Similar
Well, they have
demographics.
made a move. Yeah, they have made a move, but it's not been a move for Topshop just yet. They bought Debenhams. They bought Debenhams online sort of platform. And it's an interesting deal because it's only Debenhams online. They haven't bought the stores. The stores look like they're going to close, so it effectively splits Debenhams up a little bit. But it says in the article I read, 50 million fee, the 50 million pound fee represents this opportunity to target new customers and launch into the beauty, sports, and homewares market for the first time. So if you were wondering why Boohoo would buy a brand that is failing in Debenhams, they obviously still feel like it's got some power, don't they, Mike?
Yeah, see, I was saying to you earlier, my friend asked me about this. They said, "Why are Boohoo buying Debenhams?" And I said, "Well, maybe it's because of the some of the flagship store or two, maybe in Oxford Street or something they're after." And he was like, "No, no, they're not getting the stores." I was like, "Oh, well, maybe it's some of the designers, maybe." And he was like, "Oh, no, no, not getting the staff either." I was like, "Oh, right, okay. Well, how much are they spending?" And he said 50 million. And I said, well, that is I mean, it's a sizable chunk. But Jack rightly said earlier to me, that's minute compared to the revenues that Boohoo are making, and the profits that they're making. And then if you actually look at the brand values that some have, like Nike at saying like 350 billion, and even like Victoria's Secret at 6 billion, and things like that, these brands, if you see it has some kind of meaning to some customers, and it could be of use, it's of value. So maybe that could be seen in the future as a snip at 50 million if they can launch Debenhams online uh, completely.
Effectively, yeah, no
Yeah,
doubt.
and sell to all the old Debenhams customers that used to love Debenhams. I mean, I've heard so many people on the radio, on LBC phoning up and saying they're gonna really miss it, and it is something they did once a week. They'd wander around Debenhams, or even if it was at lunchtime, like during work, they'd always go there, and they clearly have like a really strong emotional attachment that I never realised.
And
Um,
I mean, you've kind
so
of
yeah.
alluded to another interesting point there, in the sense that the people who you've been hearing from and heard on the radio are kind of different to who Boohoo currently target. Boohoo is very much aimed towards the younger consumer, and the concept of what you were talking about, like that weekly shop in there and the walk around the store, is very much more from the older generation of consumers. And so it just represents a little bit of an interesting change to their strategy, doesn't it? It shows that they're trying to actually branch out into some new markets, and rather than just being a brand that focuses more for the younger people, there. And we mentioned beauty, sports, and homewares, but also different market in terms of like the customers they're targeting.
Yeah, definitely. It's a completely different market segment. That they were all. I mean, I'm not just assuming based on their voice or anything that the presenter asked them, because they were like they were a very different segment, I guess. And they were all 50 plus female. Yeah,
Yeah,
so that is very
yeah.
clearly their demo. And yeah, it opens up a new market segment to Boohoo if they can get going. I think they need to get going quickly though. I think online needs to get up, and I think you said you had a timeline on it, roughly.
I think they were saying spring or summer. So it's something they're planning on doing. They incorporate it into their online stores on Boohoo in the next few months, is the plan.
The only thing is Mavis, yeah, that likes to wander around there, up, on a lunch
Mavis?
break. Yeah, I've thrown a random name out there. She's Mavis. So she wanders around Debenhams, loves it. She's now really sad. Yeah, and
She's gonna go online.
is she really going to go on
Boohoo.com,
boohoo.com
yeah.
slash Debenhams or whatever they want to call it, and and actually go on the website? I don't think she is.
Because it's gonna. There was another thing that said it's gonna take some time for them to get the Debenhams website up and running
Yeah.
again. And so, yeah, it's a good point. Is this gonna work in the short term? But maybe it's not a short term decision. Maybe it's a long term plan.
And it's a small
So
amount in the grand scheme of things. I mean, that's what students have to get your head around. 50 million. I mean, I didn't get my head around that. I thought 50 million was quite a lot. But you know what? Jack's completely right. 50 million is a very small amount in the grand scheme of things,
well, their
for a
revenue
business investment.
last year was 860 million. So obviously they have costs as well. But I couldn't find their profit figures. But it's certainly affordable for a business that's clearly, since Boohoo clearly senses an opportunity to get bigger and grow where other businesses are failing. And so, yeah, I guess they have to kind of make that jump, don't they, if they want to get that position in the market. That links us actually quite nicely to our next bit. But before we move on to the Ansoffs Matrix in 5 minutes, let's take a break. So we each month do a topic in 5 minutes, and this month's is Ansoffs Matrix, which is, in my opinion, one of. I always say this to my students. I have a poster of Ansoffs Matrix on my wall. I've got like maybe 3 or 4 different business models on my displays in my classroom. Not that I'm in a classroom at the moment, and I put them there because you can refer to them in so many different circumstances with so many news stories. And I think Ansoffs Matrix is one of the most easy to refer to business theories in the entire course. And the reason that I think that is really important is what it means is the opportunities for you to bring this into an exam question and demonstrate real good knowledge to your examiners you've got so many opportunities to do it. Take that Boohoo example. You could make the argument whether that is product development, market development, diversification, or what have you. So you can link any decision that a business makes to this theory. So the concept of the model is basically it categorizes a decision that a business makes into one of these four categories, and it's based on two criteria: market, and whether the market is a new market for them or a current market for them, and product, as in whether the product is a new product or whether it's a current product. And we've got these four options. You can see them on the screen there. We've got current product and current market as market penetration. So we are just trying to get more sales, more market share within the market we're currently in. That's not very risky because we're already there. We've already got the product. We've already got the market. We know what we're doing. We've got experience, etc. So that shouldn't be very risky. And then we've got product development where we, same market, so stick to the same consumers, same geographical market, but we're going to launch a new product. This is probably going to be done where we're pretty confident that we're doing okay in this market, that our customers are going to want this new product. So quite often this could be like a sequel product or an improved product, like take the new iPhone, for example. It's sold to the same consumers who bought the last iPhone. It's just newer and hopefully better enough that consumers will still want it. There's a bit of risk here because you don't know your product's going to be successful. But generally speaking, if you're making this decision, you probably have a pretty good idea. The third one is market development, which is where we take an existing product and put it into a new market. This could be a different use for the product, for example. I know that sort of baby wipes got kind of repackaged into makeup removal wipes and different reasons where you can use those. But more commonly, it's different geographical markets. So launching a product that has worked in Europe into Asia, for example, or something like that. This is more risky because even though you know the product, there's a lot of differences between different markets. If you're in the EdXL course and you've been studying theme 4, or I mean, my students are about to start theme 4, they're about to learn about the difference between different markets in terms of income, in terms of tastes, in terms of traditions and what have you. And one of the most interesting parts of the A level, in my opinion, is when we start looking at those differences between markets. So this one has a bit more risk. And then diversification is the last one, which is the riskiest thing a business can do. It is where you do something completely new. And this could be for a variety of reasons. But most commonly, it's where you either see that what you're currently doing isn't working, so you need to do something new, or you just see an opportunity. Like one of my favorite examples to give is that Nokia, which we obviously know as a phone company, actually started off making tires. And Nintendo started off doing playing cards before becoming one of the biggest games consoles companies in the world. And both of those moves were diversification. Really, really risky at the time, but clearly quite high reward. Mike, is there anything you want to add to that?
I mean, just for a laugh, I'm not sure these kids that listen to our podcast would think of Nokia as phones. But yes, the only thing I would add in is the reward. Yeah. So you perfectly said about the risk. Yeah. So by far the riskiest diversification, by far the least riskiest the market penetration, and then your market development, product development in the middle. Very hard to say which one is the most risky out of them two. I'd probably err on the side of market rather than product,
Yeah,
but fairly similar. But the reward is also commensurate with the actual risk. Market penetration, you said very low risk, but probably very low reward. Yeah, so it's
yeah,
all about your risk to reward ratio. Diversification could fall flat on its face, but it could also be the making of you. It could see you go in double in market capitalization, etc. And then the other two again, you got medium risk but medium rewards. So it's something you have to weigh up. And the key thing that I try and get my students to look at is how long has the business been running? Yeah, because that reduces the risk you would hope from
yeah,
experience of management, etc. And how much capital do they have? Um, if you've got a balance sheet, for example, to actually play with, to go long term, like Jack, you said about Boohoo and Debenhams. If Boohoo have got the capital sitting there, so Debenhams can be a long play and it doesn't need to give any return from an
yeah,
investment
no
point of view,
doubt.
then that's fine. So you can be much more risky. So think about the business as well as just the generic kind of strategy on which one would be best.
Yeah, a really good example for this one, by the way, where you can hit all four of the boxes, would be Apple, which is probably the example I use most commonly when I'm teaching this. because you've got market penetration. Like, say, for example, if they take one of their existing products and they put it on sale or they do a new promotion for it, that's an example of market penetration. Yeah, it might get you a few more sales, but it's not going to move the needle very much. Product development, I mentioned launching the next version of the phone, next version of the iPhone, next version of the iPad, or the new headphones and what have you. It's not gonna, I mean, it's gonna give you more reward, but it's not gonna like completely revolutionize the business. Market development, there's been plenty of examples of where Apple has gradually sort of increased their reach across the globe, moving it to different continents and what have you, bringing the iPhone to Asia and Africa. But then diversification, and it's a really good example, Apple, because if you look at Apple's real growth, they were obviously a successful business in the sort of late 80s, 90s with their computers. But it wasn't really until the early 2000s, very late 90s, when they released the iPod and then the iPhone and then the MacBook. And they kind of had this succession of really successful diversifications where they became the powerhouse that they are now. And so if they had never done that new product of the iPod with the new market MP3 players, they would never have, they maybe wouldn't have actually ever got to the size that they are now, and the iPhone wouldn't be in half of our audience's pockets. So it's just a really, really good example there where you can tick all the boxes. But I'd be looking at any business decision and thinking about where this fits into Ansoffs Matrix, which is why I think it's one of the most relevant one of the most relevant topics out there.
Yeah, definitely. I mean, what the A-star students do is they look at a question that might be on, something completely not to do with Ansoff Matrix. It's not in the question. It doesn't talk about growth, but they decide that could actually work, and they can bring elasticity into it. Do you know what I mean? There's so many things um, that you could bring into any question that is not what the question is directly asking, which could make your answer feel more holistic, rounded, and that you know
Really
the whole
stand
everything.
out to an examiner as well, because it'll
Mm,
be in the mark scheme, but it won't be in the question. And so if you can identify that and you can mention it, you're going to look really, really good.
even
Let's do
better if
this
it's not in the mark
misconception
scheme.
then. Yeah,
Right.
definitely.
Okay. So misconception. Right. So this has come up. I think every year for me, but it's been more prominent because we have obviously been starting to do investment appraisal with GCSE, and they ask more questions than A level, it seems. So student misconception of the month: that profitability of a business investment is all about getting the capital back quickly to reinvest. Now, don't get me wrong. If you Google it, then the first thing you'll find is profit's important because you need that to invest in growth, etc. And that's all true. Yeah. But the problem comes in investment appraisal when you are talking about simple payback and then you go on to talk about ARR, average rate return. Um, because your first paragraph is going to be about simple payback, and that is literally getting the capital back you've invested, probably most beneficial for a small business, so you can then reinvest it. Yeah. ARR, yeah, which is linked solely to profitability, yeah, and takes the whole profit that an investment will bring into account rather than just say the first 2 or 3 years, is all about a little bit more than that. Yeah, it's about things such as when you go to a bank or go to an investor, the value of your company, yeah, how risky are you? So it might not just be enough to take that money and reinvest that capital back from the investment and then reinvest it. You might want to borrow more from a bank, yeah. So that would allow you to more easily borrow capital from a bank at a lower interest rate, etc. Or it could allow you to more easily get investors on board. Um, like if you're Netflix, for example, yeah, you need to make more shows. You want to get investors on board at the lowest cost, so you don't dilute your shares. Then that will enable you to do it. So profitability is actually a sign of how successful and how well a business is running and where it can go in the future.
It's kind of
Um,
short term, long term, isn't it? Like
yeah,
the payback, and I think yeah, you're completely right. The priority is what the business is prioritizing. If the business hasn't got huge amounts of cash flow or assets available on their balance sheet, they might require a quick payback so that they've got the money to use on other things. But if a business has got the money to play with, they might prioritize the profit because they can afford for it not to pay back in the short term. So I always mention short term versus long term with this, and you've got to think about what else you know about the business. If you know that the business has huge amounts of money, then yeah, they're probably willing to invest and wait for longer to receive their payback, and therefore the average rate of return or the accounting rate of return will be more important. If a business has to make this investment, but also actually really wants to get the money back sooner, then payback's going to be the priority. I always think of the example of, we've mentioned Arcadia a bunch, and we've mentioned Philip Green, the boss of Arcadia. One of the biggest problems with his business model, and one of the reasons they're in the situation that they're in now, is for the last sort of 20 years, he's been completely unwilling to invest in anything that wouldn't pay back within a year. Now, that's fine in the sense that that's a strategy. He obviously didn't feel like he had the money to play that long game. But what it means is some of those potentially long-term successful ventures, like, going into China and what have you, he's missed out on because he wasn't willing to have that longer payback. So I think it just, yeah, I guess all I would just say is it links to the priority of the business and the perspective of the owners of the business as much as anything else.
Yes, definitely. And it also is a sign of efficiency of how well the business is being run, which I can't, emphasize enough. Like if you've got very poor, say, gross profit, so profitability in that sense, not like going away from ARR even. Yeah, if you've got really poor gross profit, then that shows that you may have issues with your production. Yeah, your efficiency in production. So maybe you need to look at productivity. Maybe you need to look at your sourcing of materials, etc., etc. So it can tell you a whole lot more than Simple Payback can. So I'm just trying to get my students and the students that are listening to this to think a little bit more deeply about what profitability tells us about business.
Perfect. Thank you very much. The last bit from us is an exam question for A level and GCSE, and we've kind of gone a bit high tariff on these ones. We've got a 9 marker and a 20 marker, and we've got a case study. You might not be able to see it very well on the screen. It will be in the worksheet that will be on our website, and so you'll be able to see it in much more detail there. I know that the visitor prices, for example, you can't really see on this slide, but they will be full size in the worksheet. Mike, do you want to talk us through the GCSE question and what you're looking for from it?
Yeah, of course. So the GCSE question is a 9 marker. So it gives you in the case that essentially that the business is struggling financially. So the accountants have been called in and they've given the business some ideas of what they could do. These are their two recommendations. So you'll always get two recommendations or two options in a GCSE 9 marker, like you would in a 20 mark A level question. So the first option is greatly reduce the number of employees working, or option two, change the current pricing strategy. So this is a 9 marker, justify which you think is best. Now there are several ways you can do this question to achieve like a grade 9, to achieve all the marks. I suggest, and most teachers would suggest, and the exam board suggest, that you would pick an option that you think is the best option. So let's just, for argument's sake, I want to write about option one. I think I can write more about the impact of that than changing prices. What I would then do is, first paragraph, write a benefit of that. Why is it not going to be a problem having fewer employees? How is that going to then benefit the business in their current situation? Then, second paragraph, I'm going to talk about some possible problems that could arise. And then in the final paragraph, I'm going to write a fairly short conclusion. And I'm going to say it clearly is the best option because you've only written about one. And then you are going to say, however, success will depend on. And I want you to imagine you are Gordon Ramsay going into one of those restaurants to try and save it from going under. And you're giving your own kind of personal tip. I think you should reduce the number of employees working. It's clearly the best option. But if I were the manager, I would suggest they take this action whilst doing it. Maybe I'm not gonna actually. I'll almost give you an answer, but give some examples of how you would do it.
And yeah, so yeah, the A level one kind of follows a similar theme in the sense that you've got two options, and these are worded a little bit differently: reducing operational capacity or changing pricing strategy. Obviously, we'd expect a bit more theoretical knowledge behind those, so being able to maybe look outside the box and not just think about staffing for operational capacity, think about other things they potentially could do to reduce their capacity. And it effectively asks, evaluate the two options and recommend which is more likely to improve their chances of survival. So structure wise, we always go with, and we've got, and they're linked at the end of this presentation, a playlist with some um, exam technique videos for these types of questions. So there's a 20 mark video. So you can have a look at that if you want a bit more structural guidance. But we want a peach paragraph for both of those options and then a conclusion. I kind of use a disc structure with my conclusion, but there are others available. So yeah, give it a go and submit your answers. And we have to apologize to Daisy, who was one of the many students who sent in an answer to a question that we put in December's, because we usually try and reply to those as quick as possible and give you feedback straight away. But hers slipped past and went into the junk mail. So we actually only replied today when we were going on to sort of clear out the mailbox ready for this podcast. So shout out to Daisy for writing a really good answer, and also apologies again for not picking it up straight away.
Yeah, it's a cracking
So
answer that.
it was a great answer. And so we just encourage anyone who sends in an answer, we will have a look at it and we'll give you some feedback. So if you just want a fresh set of eyes on an exam question, obviously, I think assessments, we haven't had any information yet, but I think assessments are going to be a key part of this summer's awarding of grades. And so keep working, keep practicing these things. And if we can do anything to help, then we'd be more than happy to. Thank you for watching February's episode. Make sure that you hit our website up if you want to download any of the resources of the worksheets. Our website is www.edifyed.co.uk/business, because we're part of the Edify podcast network. And don't forget to follow us on Twitter and Instagram at BusinessAUPod. I'll also put our email address on there if you have any questions that you've done that you want us to have a look at. Our email address is businessaupod@outlook.com. Have a good half term when it comes, and we look forward to speaking to you guys next month. See you,
Yep,
Mike.
see you soon.